we need to talk about the American Airlines market-based cash balance plan. So as of today, November 24th, you guys need to choose whether you're going to opt in to this American Airlines market-based cash balance plan or you are going to opt out of it. So you've got this window from today until December 15th. So in today's episode, we are going to refresh ourselves. What is the market-based cash balance plan? When the market-based cash balance plan would apply to you. American Airlines, you guys had some different features in your plan than the rest of the industry. We're going to go over that. Also, let's compare it to your 401k. What's similar? What's different? And then we will wrap up with the question that everybody wants to know. Is this plan good? Should I opt in or should I opt out?
You're listening to The Pilot's Portfolio, the show dedicated to guiding professional pilots towards a future of financial success and stability. Fly along with your host, Timothy P. Pope, as he provides financial planning insights and answers to your burning questions and dives into real-life stories from fellow pilots who share their successes and cautionary tales. The Pilot's Portfolio takes off now.
Well, welcome to this episode of Pilot's Portfolio. If you're new here, thanks for joining us. My name is Timothy P. Pope. I'm your host. I'm a certified financial planner and principal at 360 Aviation Advisors, where we focus on financial planning for the professional pilot. I'm also a GA pilot flying the 172 and the SR-20. So love to get some time in the air when I actually have the time to do it. So with that, let's get started. Let's jump into today's episode. So the first question, what is the market-based cash balance plan? On its face, right, it's an additional retirement plan to help you defer taxes that you would have otherwise paid today when you receive the company's NEC or non-elective contribution. So a few episodes ago, I told you about the IRS contribution limits for 2026. So if you missed that episode, go back and listen to it and then kind of outline everything for you there. But you'll recall that the 2026 401k contribution limit for you to put in, if you're under the age of 50, is $24,500. And you can do that either pre-tax or you can do Roth. And for a moment, we're going to ignore the mega backdoor strategies here. All right. So you can put that $24,500 in, and then your money and the company's money together cannot exceed $72,000. All right. There are some nuances. So if you are 50 or older or between 61 and 63, you can put in a bit more money than what I just mentioned. It's not going to count against that $72,000 limit. So here's where the market-based cash balance plan comes in. Because as you guys know, with your most recent contract, you have this incredible company contribution, not even a match. You show up, you fly the airplane. In 2026, the company is going to put away 18% of your compensation inside of your 401k. The problem is, with 18% on the salaries that you guys command, we quickly run out of tax-deferred places for that non-elective contribution to go. So all the major airlines went to the IRS and they asked for permission to begin using what's called a market-based cash balance plan. These plans are very popular in other industries where folks are highly compensated and run into the same problems that you do. Hey, we have all this money, we're running out of places for tax-deferred growth. Recently, the IRS has given American the blessing to use this plan. And so now you guys have to make this choice between now and December 15th on if you're going to participate. Essentially, the way it works is your 401k starts to fill up, and when you either hit the $72,000 between yourself and the company's contributions, then the rest of it is either going to go to the market-based cash balance plan if you choose that, or it's going to come to you in cash. The other way is that if you are making more than $360,000 a year, then the non-elective contribution is going to stop going into your 401k. And if you choose the market-based cash balance plan, it's going to start filling up there instead. So let's go over some numbers. When would the market-based cash balance plan be applicable to you? All right. So number one, if you're maxing out your 401k in 2026, you can expect to receive spill cash when your earnings exceed $264,000 from the company. All right. So then that spill cash, that's what we're talking about here. Does that just continue to be sent to you in your check as it's done today? Or do you opt into the market-based cash balance plan and it's deferred and you don't pay taxes on it as it flows into your market-based cash balance plan? At least you don't pay taxes on it today. The other scenario, going to do the bookends here, is if you're putting $0 in your 401k, you can expect spill cash when your earnings exceed $360,000. Okay. That $360,000 is the number the IRS says, hey, the company can only consider putting the NEC into your 401k on your first $360,000 of earnings. Above $360,000, the NEC has to go somewhere else. Again, to you in a paycheck where you pay taxes on it, or to the market-based cash balance plan where you defer taxes. So in the first example, we had $264,000. The second example, we're at $360,000. That's almost $100,000 difference, okay, of when you can expect spill cash or not, given if you're maxing out the 401k or not. So if you are contributing something in between 0 and the max of $24,500, then you can expect spill cash somewhere in the middle, all right? So we've gone over the numbers there. Let's talk about how American Airlines plan differs from the rest of the industry. And here's where it differs from the rest of the industry so far. It differs because you guys have choice, all right? You can choose in 3-year segments whether you're going to participate in this. So let's say that you choose by December 15th to participate, then you're going to participate in the market cash balance plan in 26, 27, and 28. All right. And then at the end of 28, you're going to have another choice. Hey, do I want to continue participating in this or do I not want to continue participating in this? So every 3 years, you've got an option to either opt in or opt out. And from a financial planning perspective, that is an extraordinarily valuable planning tool. That is a really big deal because you guys will remember a couple years ago when Delta came out with theirs, their pilots had to make an irrevocable choice. All right, whether they opted in or opted out. Hopefully that maybe they can revisit that and give their pilots choice like this. United pilots, the plan they came up with was an annual choice. Now, they have not passed their market-based cash balance plan yet. They've not implemented it yet. It looks like it's run into some issues there, but we see that, hey, you know what? The IRS kind of likes at least a 3-year window. So that seems to be cool. And then with Southwest, they just said, hey, you guys are going to get this, right? So you're going to get 1% into it, and then you're going to get 2% into it starting in 2026. So that's how it changes or it differs from the industry. And, let's talk about that flexibility there for a moment. As a planner, I can see just a number of scenarios where that flexibility could come in handy for you. Let's say that you're in a stage right now where you're saying, look, I need to build some non-qualified assets. When we say non-qualified, we mean brokerage. We mean I can spend it today money. We mean I call it no strings attached money with the clients, right? So we need to build some non-qualified assets because we've got some plans that we need to take care of before age 60, which is the earliest that you could roll money out of this market-based cash flow plan, or 59 and a half if we're counting half years. So you've got some plans that you need money now. Maybe you're in a scenario where you inherited some retirement accounts from your parents, and next thing you know, you need to distribute $1 million or more. And because of the changes in the rules on those plans, you've got 10 years to do it, but you're doing pretty well at your current job at the airlines, and your spouse is doing well also. So, maybe in that scenario, you opt in to defer the spill cash while you unwind some of these pre-tax accounts, okay? Maybe, you're about to sell several rentals and you're not going to 1031 it because, you need the cash. And so maybe you're going to be facing capital gains, depreciation recapture, and so forth. And so maybe you decide to just defer the spill cash for a few years. So the ability to choose every 3 years, I think, is an extraordinarily valuable planning tool. And as it relates to market-based cash balance plans in and of themselves, I think that one, this feature here pushes the American plan to be my favorite of what we have out in the industry right now. So let's take a look at how it differs from your 401k. Unlike your 401k, you are not going to be able to directly influence how much money you put into this plan, okay? This is all formula driven. It's all based off of how much NEC you earn and if that NEC exceeds some of the limits that we talked about previously. So you're not going to have direct control over how much spill cash goes into the market-based cash balance plan. There are some levers that you could pull, like you could reduce your own $24,500 You could reduce that down to some number less than that, all the way down to zero, and allow more money to go into your 401k or market-based cash balance plan. So there's some ways to indirectly control it, but unlike your 401k, you can't go and say, hey, I want 10% or 5% or whatever going into this market-based cash balance plan. Number two, it's different because in your 401k, you have complete control over the investments. Okay, so you can build a portfolio that suits your needs. And since you are the one building the portfolios, you also are bearing the investment risk and responsibility. In the market-based cash balance plan, you do not get to control the investments. Typically, these plans are going to be invested in a more conservative manner because they do guarantee that when you take your money out, you will have no less than what you put in. Now, as we talk about the investment side, APA and the company has done an excellent job creating this plan, especially giving you guys the flexibility to choose every 3 years. I love that. And I think that's what we call a real valuable financial planning tool. But what frustrates me and what should frustrate you, and you should raise your collective 16,000 voices and say, we want more transparency on how these investments are going to be managed. In the 23 pages of documents that I've reviewed about this plan, when it comes to investment management, all you guys get is a sentence that says, market-based cash balance plan assets will be professionally managed by an investment manager selected by the market-based cash balance pension plans fiduciary. That's cool, but we want more than that. Okay. At least in the Delta's plans, they said the fund manager is going to target, 40% stock and 60% bond allocation. So then as planners, we can go and look up historically how that mix of stocks and bonds have performed over the long term. And then we can apply that rate of return to any money you have in your plan. And then also knowing that in that mix of how the plan is going to be invested, we can go and reallocate other parts of your portfolio. So APA, American, market-based cash balance, pension plan fiduciary, we need a little bit more from you. You guys, please tell these pilots the target asset allocation on this. Tell the pilots that you reserve the right to deviate from that target asset allocation from the time to time. And then tell the pilots the guardrails that if and when you deviate, here are the guardrails you're going to stay within. Now, I'm fairly certain that that's just par for the course whenever managing money. Ask me how I know. All right. So you're not going to be able to have complete control over the investments. But on that point, we do need and we want more information on how they plan to invest this. Number three, there are going to be no Roth conversions inside the market-based cash balance plan. All right. So inside that plan itself, once the money's in there, it is going in there tax deferred. It's going to stay tax deferred until you roll that into an IRA later. And then once it's in the IRA, you can do whatever you want with it. There are some similarities to your 401k. It does enjoy unlimited creditor protection. Just like your 401k is not subject to the company's creditors, especially in the case of a bankruptcy situation, the market-based cash balance plan also enjoys that protection. And just like, your 401k in many cases is not subject to your own. Let's say you get into a sticky situation, you have some liability, your 401k is not subject to those creditors either, and the market-based cash balance plan would not be as well. Also, let's talk about beneficiaries. If you die before you get a chance to use this money, it will be passed to your beneficiaries as you elect. And so both of those elements are the same as your 401k.
Hey, pilot, are you looking to save 20% on the sale or purchase of your next home? Let me tell you about a friend of the show, Beacon Relocation. With Beacon's exclusive real estate benefit, you can save thousands. My family has actually used their services when we needed to sell a property that was multiple states away. Beacon has over 1,500 experienced agents providing outstanding service and expertise as they guide you through every step of the buying or selling process. They'll even connect you with a national lender who offers competitive rates and discounted programs. As a Pilot's Portfolio listener, you are eligible to receive 20% of the real estate agent's commission towards your closing cost on the sale or purchase of your home. Visit beaconrelocation.com today. Select Pilot's Portfolio via the Apply Now drop-down menu to activate your benefits and make your next move your best move.
Buyer credit varies in some states. Contact us for details.
Now, let's get to the question that everybody wants to know. Is this plan good for me? Should I opt in and should I opt out? I'll tell you, I have listened to other advisors on this topic. Actually, when Delta's was coming out, I've listened to others and they take a really negative view on the market-based cash balance plan. Okay. And I think when you look at it and you say, look, the only thing that this thing offers is a conservative investment with a tax deferral feature, it's bad. I think that's a rather simplistic view of the plan. It really doesn't consider the flexibility to someone's broader financial life that this can offer and the nuance that all of you guys have in your lives. Okay. If you're maxing out your 401k and you've been doing that for a long time, and the company is also giving you a whole lot of NEC, chances are the goals that you are focused on are not simply retirement goals, right? Like retirement's going to be fine. But then there's other goals that take its place. We think about legacy. We think about just flexibility to do other things. I say, okay, so when you think about the market-based cash balance plan, you want to think about it as a flexible tool. So, maybe you're late to the savings game. Maybe you need to save as much as possible so you can be successful in retirement. But you know yourself, and you know that if the funds end up inside your bank account, you're probably going to spend them. A market-based cash balance plan is probably useful for you. One of the features in the market-based cash balance plan is that you can't do Roth conversions. But I do think the market-based cash balance plan can actually enhance your Roth positions without having to pay more tax than you would like if you had taken this cash. I want to give you an example on that, okay? And I'm not going to dive deep on this. I'm not going to say everybody should use it, but I'm just going to let you know, like, hey, here's a strategy that's out there that you could use. So let's say, for example, you max out your 401k and you do Roth at $24,500. And then you also do backdoor Roths for you and your spouse. Let's say you're married, filing jointly at $7,500 each year. Okay. So that's $39,500. Where else can you go to get more tax-free Roth shelf space? And if you say, well, you could do mega backdoor Roth conversions, you would be right. With the market-based cash balance plan, if you elected that, you would still receive spill cash as cash, and that portion would not go to the market-based cash balance plan. So we're going to ignore those mega backdoor Roth conversions for a moment. After you max out your $24,500, you do your $15,000 in backdoor Roths. Okay, that's $39,500 in tax-free Roth shelf space. We love that. Where else can you go to get more tax-free Roth shelf space? The only place you can go is you can do Roth conversions, right? And those are going to be taxable to you in the year in which you convert them. So either you take the NEC as cash, all right, so you pay taxes on that, you toss that money in a brokerage account, and then you do Roth conversions, you're going to have to pay more tax on the Roth conversion. So now you paid tax on the spill cash and you've paid tax on the Roth conversions, okay? Or if you elect the market-based cash balance plan, you can calculate every year, hey, how much money would I have paid on the spill cash that went into the market-based cash balance plan? And then you convert a similar portion from the 401k, or if you got old IRAs. And that way you've expanded your shelf space, your tax-free shelf space, without having to pay tax on both the NEC that you receive as cash and the Roth conversion. Look, why would somebody want to do that? Well, brokerage account, I am going to pay taxes on it now, and then I'm going to pay tax on my long-term capital gains, either 15% or 20%. Hey, that is better than 35 or 37% for sure, but it's still 15 or 20%. In the Roth, I pay taxes on it once, and then I never pay taxes on the gains. So for one thing, we can think about legacy planning. Hey, I've got everything that I need. I'm really thinking about the next generation here. I'd like to leave them the biggest bucket of Roth dollars as I can, because they're not going to have to pay taxes on it. Yes, in a brokerage, they'll get a step-up basis, but still, that's not tax-free. It depends on how they use it, but the Roth is. So, is this a strategy for everybody? No. Is it a strategy to use all the time? No. Could it be useful? Yes. Okay. And I say that to just demonstrate the flexibility that this plan could use. Maybe you are, running a company and your return on capital far exceeds what your money does in the market. Okay. Especially when you factor in the tax breaks and so on. All right, well, in that case, maybe you're not interested in using the market-based cash balance plan. So think about this as a tool, guys. It's, when we use the right tool for the right job, it's awesome. If we use the wrong tool for the job, then it's terrible, okay? If you ask me, Tim, how do you feel about screwdrivers? I'm like, well, If I'm doing a pre-flight on the Cessna and I see that the rivet on the cowling has popped out once again, as it's known to do, I love myself a screwdriver and pop that thing back in before takeoff. But if I'm looking at the wooden picnic table in the backyard that the kids have broken and I want to pound some nails in it to get it fixed, I'm not interested in a screwdriver. And please don't ask me how you break a picnic table. I have no idea. I asked my wife the same thing. How in the world did they break this? So I think bottom line, with the market-based cash balance plan, it's not inherently good or bad. I do like the flexibility on it. I do think you guys should consider your own financial circumstance and then make a decision from there. And the good news about it is, look, you get to choose in another 3 years anyway. So if someone is saying, hey, this plan is terrible, I think that's a fairly simplistic view of it. And it certainly doesn't consider all the nuances that you guys have in your financial lives. So with that, be sure, make your decision by December 15th of this year. Thanks for joining this episode of Pilot's Portfolio, and we'll see you on the next show.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors. 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's Portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.